When modeling financial markets, one of the first and most important decisions you have to make is what exactly you're trying to model. Prices might seem like the obvious choice. They're what we see on charts, what traders watch, and what gets reported in the news. But in quantitative finance, we rarely model prices directly. Instead, we focus on returns, and more specifically, log returns. To understand why, consider how prices actually change over time. If a price moves from $100 to $110, that's a gain of 10%. But if it falls from $110 back to $100, the loss isn't 10%, it's slightly larger, around 9.09%. This creates an asymmetry that makes raw price movements harder to work with mathematically, especially when you try to analyze behavior over multiple periods. One way to improve this is by looking at returns instead of prices. Returns measure relative change, how much something grows or shrinks compared to its starting point. This makes comparisons more meaningful because a 10% move means the thing whether the price is 10, 100 or $1,000. It also allows us to normalize movements across different assets and time periods. But even simple returns have limitations. They don't accurately combine cleanly over time. If you try to add returns across multiple periods, you don't get total return, you get something distorted. Instead, returns compound multiplicatively, which makes long-term analysis more complicated and less intuitive. This is where log returns come in. Log returns are defined as the natural logarithm of the ratio between consecutive prices. At first glance, this might seem like a small technical adjustment, but it fundamentally changes how the math behaves. The key advantage is that log returns are additive over time. That means if you sum log returns across multiple periods, you get the total return directly without needing to account for compounding in a complex way. This property makes log returns much easier to work with in mathematical models. It allows us to apply tools from probability and statistics more cleanly, and it simplifies how we describe the evolution of financial variables over time. In particular, it creates a natural bridge between discrete changes and continuous time models. This is where the Brownian motion enters the picture again. If we assume that log returns are normally distributed, then the price process that results in is known as the Geometric Brownian Motion. In this framework, we're not modeling prices directly, we're modeling the randomness in returns and letting prices emerge as the exponential of that process. This approach has several important consequences. It ensures that prices always remain positive, which is essential in financial modeling. It captures both the drift or long-term trend and the volatility or randomness in a consistent way. And most importantly, it connects everything, randomness, time, and growth, into a single coherent structure. So that shift from prices to log returns isn't just a technical detail, it's a fundamental step towards modeling markets in a way that is both mathematically sound and practically useful.